Hi everyone. Today I will explain Modigliani and Miller propositions with corporation tax in a simple and practical way. Let's get started. This theory was developed by Franco Modigliani and Miller. M&M can be used to calculate the cost of equity and the WACC in a company where the level of gearing changes, provided there is no change in the overall business risk. That is, M&M formula applies only when the size of the company is unchanged and equity replaces debt or debt replaces equity. Let's draw a diagram to illustrate the relationship between cost of debt, cost of capital and gearing. So cost of capital. Then we have gearing. A business is geared when it is financed with debt. So this is cost of debt. Cost of debt, KD. Cost of debt. Then we have cost of equity. This is cost of equity, KE. Then we also have the weighted average cost of capital, WACC. WACC, weighted average cost of capital, WACC. So we want to start with M&M Proposition 1 with tax. Modigliani and Miller Proposition 1. So M and M Proposition 1 with tax. M&M Proposition 1 with tax. Proposition 1 focuses on three things. Proposition 1 focuses on 1. We have the value of the firm. 2. The WACC. 3. Effect of tax sheet. Proposition 1 focus on value of the firm. 2. WACC, weighted average cost of capital. 3. The effect of tax sheet. Effect of tax sheet. So, Proposition 1 centered on these three things. So, we are starting with number 1, which is value of the firm. So, in accordance with M&M Proposition 1, value of a geared company is greater than the value of an ungeared company. Value of a geared company is greater than value of an ungeared company. That is value of the firm. So we have value of the firm. In accordance with M&M Proposition 1, value of geared company is greater than value of an ungeared company. So the formula for calculating the value of geared company, value of geared equal to value of an ungeared plus DT. Value of geared company equal to value of an ungeared company plus DT. I've told you that in accordance with M&M Proposition 1, the value of a geared company will be greater than the value of an ungeared company. 2. We have the WACC. I've told you that Proposition 1 focuses on three things. We have the value of the firm. In accordance with M&M Proposition 1, we said the value of a geared company will be greater than the value of an ungeared company. So, we have the formula to be VG equal to VU plus DT. And the second item that Proposition 1 centered on is the WACC, weighted average cost of capital. If you look at the WACC from this diagram, so what happens to gearing here? So we might have gearing at this level, let's say 1, 2, 3. What happened to the WACC? So at this level, WACC is still very high. So what happens here? As the gearing increases, what happens to WACC? WACC is decreasing. What happened to WACC here? It decreased further. So it means, in accordance with M&M Proposition 1, WACC decreases as gearing increases. As gearing is increasing, WACC continues to decrease. WACC decreases as gearing increases. So that is, as debt increases, WACC continue to decrease. So that is M&M Proposition 1. So the formula for calculating WACC, we have WACC of a geared company. WACC of a geared company equal to WACC of an ungeared company. This VG stands for WACC of geared. VU stands for WACC of an ungeared company into 1 minus dt over E plus D, where VG stands for WACC of geared company. Remember from the formula, this formula, VG stands for value of geared company. Then VU stands for value of an ungeared company. The D stands for value of debt, and T stands for tax rate. So, and in this WACC formula, the VG stands for WACC of a geared company. So this VA CCG, that is WACC of a geared company. VACCU, that is WACC of an ungeared company. WACC of an ungeared company. Then D stands for value of debt. Then T stands for tax rate. E stands for value of equity. Value of equity. That is M&M Proposition 1 with tax. So we said the value of the firm, value of geared company, will be greater than the value of an ungeared company. Then the WACC decreases. WACC decreases as gearing increases. Having examined M&M Proposition 1, then we want to consider M&M Proposition 2 with tax. Proposition 2, M&M Proposition 2 focuses on 3 things. 1, we have cost of equity. Cost of equity. 2, cost of debt. 3, we have financial risk. These are the 3 things that M&M Proposition 2 centered on. So if you look at the diagram on the board, what happened to cost of equity here? So if gearing is 1, the cost of equity may be here. So when gearing increases to 2, the cost of equity, if you are tracing the value here, the value here will be higher. If gearing increases to 3, so you see, as gearing increases, what happens to cost of equity? Cost of equity keeps increasing. That is M&M Proposition 2. Cost of equity of a geared company is higher than the cost of equity in an ungeared company. So if you know this place, the gearing is 0. The cost of equity here is lower. But when it is geared now, what happens to cost of equity? It increases. So that is why we said the cost of equity of a geared company is higher than the cost of equity in an ungeared company. Then you can also as well say cost of equity increases as gearing increases. You see that as gearing is increasing, cost of equity keep increasing. So that is M&M Proposition 2 with stars. Cost of equity increases. So we are examining cost of equity. Cost of equity, which is number 1. Cost of equity. We say as gearing increases, cost of equity continues to increase. So the formula for calculating the cost of equity is KAG. That is cost of equity of a geared company equal to Q. That is cost of equity in an ungeared company plus financial effect or financing effect. 1 minus tax rate into Q minus cost of debt, KD into debt to equity ratio. So the formula for calculating the cost of equity is KAG equal to Q plus 1 minus tax rate into Q minus KD into D over E. This formula will be given in a formula sheet in your question paper. So this KAG is cost of equity of a geared company. That is KAG. Cost of equity of a geared company. Then the Q, that is cost of equity in an ungeared company. Cost of equity in an ungeared company. T, that is tax rate as before. So KD, that is cost of debt. Cost of debt. Then the letter D stands for value of debt. That is market value of debt. And the E is the value of equity. That is the market value of equity. So that is the formula for calculating the cost of equity in accordance with M&M Proposition 2. So now, back to the same diagram. Remember, I've told you that Proposition 2 focuses on 3 major things. Number 1 is cost of equity. The second one is cost of debt. And the third one is financial risk. So what does M&M Proposition 2 say about the cost of debt? So this is the cost of debt line. It is horizontal. So there could be 1 here. Let's assume this is 10% cost of capital. If it is 10%, if debt is 1, cost of capital is 10%. If debt is 2, it remains 10%. If it is 3, we still have 10%. So what can we say about that? Cost of debt is constant at all levels of gearing. At all levels of gearing, cost of debt is constant. Example 1. This question is obtained from ICAN study test, financial management. The same question can also be found in ICAN study test, strategic financial management. both at the scale level and at professional level. And all equity company has a market value of 60 million naira and a cost of equity of 8%. It borrows 20 million of debt finance, costing 5%, and uses this to buy back and cancel 20 million of equity. The rate of corporation tax is 25% required. Calculate the market value and the WACC of the geared company. So now, they have the solution to the question. The company was financed with only equity before. That means it was ungeared before. Now, they now want to borrow 20 million debt to cancel 20 million of equity. So that means the company is moving from ungeared to geared. Moving from ungeared to geared. The company is moving from ungeared to geared. Ungeared means it is financed with only equity. When it is geared, it will now be financed with both equity and debt. And you have to calculate the market value. Calculate the market value and WACC of the companies. Two things are required. The market value of a geared company and WACC of a geared company. And the formula I gave you, value of geared company equal to value of an ungeared company plus DT. And I've told you that the VG stands for the market value of a geared company, while value of ungeared company is VU, the market value of debt, and the tax rate. So if you go by the question, the company was not geared before. That means it was ungeared. So when the company was not geared, what was the value of the firm or of the business that was not geared? And all equity company has a market value of 60 million. That means the market value of the company when it was ungeared was 60 million. Value of ungeared company is 60 million naira. So the company was not geared when its value was 60 million. And a cost of equity of 8%, you are given cost of equity of 8% when the company was not geared. This is the market value of the company when it was not geared. The company which was not geared now want to resort into arbitrages by borrowing 20 million naira of debt finance. So that means the value of debt will now be 20 million. 20 million naira. So the tax rate is given to be 25%. That is the tax rate given in the question. So what would that be the value of a geared company? Value of geared company is value of an ungeared, and the value of an ungeared is 60 million. 60 million naira plus D, which is 20 million, times tax rate, a tax rate of 25%, which is 0.25. So we have 60 million naira plus 20 million times 0.25, that gives us 5 million naira. So value of a geared company now will be 65 million naira. So this is the value of the company when it is geared. Now when the company was not geared, its value was 60 million. So this value of 65 million is comprises of how much is the value of debt? 20 million. No, they want to borrow 20 million as debt finance. 20 million as debt. That is 20 million of debt finance. So that means of the 65 million, equity will be 45 million naira. 45 million. That is 65 million minus 20 million. That will give you the value of equity. So the value of the firm now, when it is geared, is 65 million, comprises of 45 million value of equity and 20 million value of debt. Then we've done with value, market value. Then the next thing is WACC. So we want to calculate the WACC of the geared company. And I've given you the formula for calculating the WACC of a geared company. I said WACC of a geared company equals to, we have WACC of a geared company equal to WACC of an ungeared company into 1 minus dt over E plus D. So this is the formula for calculating the WACC of a geared company. Now, the WACC of an ungeared company is given in the question. Since the question was all equity finance before, that means the cost of equity will be equal to the WACC of an ungeared. Since the company was not geared before, the only source of finance is equity. Since the company is financed with only equity, the cost of equity will be its WACC. So that means the WACC of an ungeared company equal to the cost of equity. Since the company is all equity finance, therefore the cost of equity equal WACC of ungeared company. The only source of finance is equity. So since the only source of finance is equity, then the cost of equity will be the WACC of an ungeared company. Now back to the question. You have the cost of equity to be 8%. That means the WACC of an ungeared company is 8%. So we have WACC of an ungeared company equals to 8% from the formula. We've known this. Then D, market value of debt, which is 20 million. T, which is tax rate, 25% as given. Then E, the market value of equity. From our initial estimate now, we have the value of equity to be 45 million. 45 million. So with this information, you can substitute into the WACC formula in order to calculate the required WACC of a geared company. So what will now be the WACC? WACC of a geared company now. WACC of a geared company equal to WACC of an ungeared company, which is 8%, plus into, it is multiplied by 1 minus D. Our D is 20 million times tax rate, 25%, over value of equity, which is 45 million, plus value of debt, which is 20 million. So we have 8% into 1 minus 20 times 0.25, that gives us 5 million over, this is 65 million, the total. So we have 8% into 1 minus 5 divided by 65, that gives us 0.0769. You subtract it from 1, then you'll be left with 0.92307. So multiply by 8%. So we have 7.38%. So when you multiply by 8%, therefore WACC of a geared company equal to 7.38%. So this is the solution to example 1. Change in gearing, the WACC and capital investment appraisal. M&M with taxation from one level of gearing to another. When the project changes gearing, we cannot use the old WACC in project appraisal. Where the gearing level changes, you cannot use the old WACC in project appraisal. We must first remove the old debt effects, then apply the new debt level, and finally calculate the new WACC that will be used in project appraisal. So steps to follow in calculating the WACC that will be used in project appraisal when a business change or project change gearing. Step number 1, you de-gear the gear or you ungear. That is the first step. That is, you find business risk. That is, you remove the old gearing. This one means remove the old gearing. That is the meaning of the gear. That is, you determine the business risk. Remember, gearing can change, but business risk cannot change. Step number 2, you re-gear. Step 2, re-gear. To re-gear means you apply the new debt level. Apply new gearing. That is the meaning of re-gear. Apply new gearing. Apply new gearing. Step 3, recalculate WACC. Recalculate the new WACC. Or let me just say calculate the new WACC. So you calculate the new WACC that will be used in project appraisal. These are the steps to follow when a business change gearing, that is, in accordance with M&M Propositions with tax. Example 2. A company has a total current value of 100 million naira, consisting of 80 million naira equity and 20 million naira of debt capital. The cost of equity is 10% and the pre-tax cost of the debt capital is 6%. The rate of tax on company's profit is 25%. The company proposes to borrow an additional 20 million naira of debt capital and use the money to buy back and cancel 20 million naira of its equity required. According to Modigliani and Miller, what will be the following values for the company at its new level of gearing? A, its total value divided into a value for the equity and a value for the debt capital. B, its WACC. C, the cost of its equity capital. The question is obtained from ICAN study test. It can be found in both FM and SFM study test. In the A part of the question, you are to calculate the total value divided into value of equity and value for the debt capital. So we want to use the Modigliani and Miller proposition to determine the value of the company. So now this company was geared. The company has a total current value of 100 million. That is the total market value of the company. And this market value consists of 80 million equity and 20 million of debt. So that means the company is moving from gear to gear. Moving solution. The company is moving from gear to gear. It's different from the first example in which the company was moving from ungear to gear. But in this case, it was formerly gear. Then you now want to move from gear to gear. And when you are moving from gear to another level of gearing, you have to ungear the company first. Remember, according to M&M Proposition 1, we said value of gear company. Value of gear company equal to value of ungear plus DT. So we have to ungear. Ungear means you determine the value of ungear company. That is the first thing to do. And the value of gear company value of GH was 100 million. It was G before. Its old value, you have to use the old value to ungear. The old value was 100 million. So, and this 100 million consisting of 80 million equity and 20 million of debt. So, and the value of debt is 20 million. Then, what is the tax rate? The cost of equity is 10% and the pre-tax cost of debt capital is 6%. The rate of tax on company's profit is 25%. Tax rate is 25%. So you first of all ungear the company by calculating the value of ungeared company as if the company is all equity finance. So value of gear, which is the VG, value of gear company is 100 million. Equal to value of ungeared company, that is what we are looking for, VU, plus the value of debt, 20 million, times tax rate, 25%. So we have 100 million equal to VU plus, this will be 5 million. So make your VU the subject of the formula. So, 20 million times 0.25, that gives us 5. Make your VU the subject, you collect the items. So VU equals to 100 million. When this one comes to this side, to join 100 million, the plus here becomes minus 5 million. Therefore, value of ungeared company will be 95 million naira. So, now that you've determined the value of ungeared company, so the first step is to ungear. Now I gave you 3 steps. Ungear. So that is or the gear. That is the first thing we've done. The step 2 now. Step 2, you regear. So you want to regear. That is the next step. So by calculating the value of geared company at the new level of gearing, you were told the company proposes to borrow an additional 20 million naira. If it borrows additional 20 million naira of debt, so the value of debt now, the company was initially having 20 million debt. 20 million. If additional 20 million debt is borrowed, another 20 million debt. So the value of debt becomes 40 million naira. So the value of debt becomes 40 million. Now you have the value of debt to be 40 million. Remember, tax rate remains the same, 25%. And value of a geared company, VG, equals to, don't forget the formula. I've told you the formula will be given in the formula page of your question paper to be given, which is towards the last page of your question. So value of geared company, we say it is VU plus GT. So value of geared company, our VU, which is 95 million, plus D, which is now 40 million, times tax rate, which is 25% as before. So we have 40 times 0.25, then we get 10 million. So we have 95 million plus, this gives us 10 million. If you add it together, you have 105 million. Therefore, value of geared company equals to 105 million naira. This 105 million, which is now the new value, comprises of value of equity and value of debt. We have equity, we have debt. And remember, the value of debt will not change. It will remain the same. It will not change. The value of debt is 40 million as calculated. 40 million naira. Of 105, if 40 million naira is for debt, then the remaining 65 million naira will be the value of equity. That is 105 million minus 40 million. So we have the value of equity to be 65 million naira. Now we've done with the A part of the question. Is total value divided into a value for the equity and a value for the debt. So that is the solution to A. Then the B part of the question, you have to determine its WACC. Since we have not known the value of equity, cost of equity rather, at the new level of gearing, and cost of debt at the new level of gearing. So that means there is no way we can calculate the value of WACC directly. So the next, to answer B now, we want to calculate the value of WACC, the weighted average cost of capital. That is what we want to calculate. And I've given you the formula for WACC of a geared company. WACC of geared equal to WACC of an ungeared company. WACC of an ungeared into 1 minus dt over E plus D. So this is the formula I gave you based on M&M Proposition 2 with tax. So the WACC of a jet company, are we given the WACC of a jet company based on the old WACC, old level of gearing? So let's check if we were given. A company has a total current value of 100 million. This is the market value at the old level, consisting of 80 million equity. That was the market value of equity, 20 million of debt capital. The cost of equity is 10% and the pre-tax cost of debt capital is 6%. You were not given WACC at the old level of gearing. You need to calculate the WACC at the old level of gearing. So calculation of old WACC. So we have capital structure consisting of equity and debt. The market value of equity. You have the total value of the firm to be 100 million, consisting of 80 million equity and 20 million debt. The market value of equity, 80 million, and that of debt, 20 million. The cost of capital the cost of capital you were given. The cost of equity is 10%. And pre-tax cost of debt is 6%. So the cost of debt you need to use is post-tax. Post-tax cost of debt will be pre-tax, which is 6%. 6% into 1 minus tax rate. Tax rate is 25%. That means 1 minus 0.25, that gives us 0.75 times 6. So we have 4.5%. Always use post-tax where you are given pre-tax. So the post-tax cost of debt is 4.5%. So hash total 10%. 4.5% of 20. That gives us 0.9. 4.5% of 20. 10% of 80, that will give us 8. So if you sum up this, you have 8.9. If you sum up this, we have 100 million. Remember, WACC is hash total over cost of capital. Hash total over cost of capital will give us WACC. So, hash total over market value. WACC equals to hash total over market value. Times 100 over 1. The hash total is 8.9. The market value is 100 times 100 over 1. Therefore, we have the old WACC to be, if 100 cancel 100, you'll be left with 8.9%. So that is the existing WACC of the company, the old WACC at the old level of gearing. Now that you have gotten the old WACC, you'll be able to apply the M&M Proposition 2. You ungear the WACC you calculated. So based on M&M Proposition 2, we have the company was geared. That means the 8.9% we got is the WACC of a geared company. Then I've told you you want to move from one level of gearing to another level of gearing. You have to ungear first. So now we want to ungear now. So the WACC of geared company is what we have calculated. WACC of geared company, that is 8.9% we got. The old WACC is 8.9%. The value of debt, the old debt is 20 million. Given. The old equity is 80 million. As given in the question, the tax rate still remains 25%. As given in the question. So you want to ungear or degear. Now I gave you 3 steps. You first of all ungear or you degear. So you want to ungear by calculating WACC of ungeared company. WACC of geared company is 8.9% as calculated, equals to WACC of an ungeared company, that is unknown, into 1 minus D. D is 20 million times tax rate of 25% over equity 80 million plus debt 20 million. So we have 8.9% equals to WACC of an ungeared company into 1 minus. So this is 20 times 0.25, that gives us 5. Then 5 divided by 80 plus 20, that is 100, divided by 100. Then that gives us 0.05. This is 5, the numerator is 5, denominator is 100. 5 over 100, that is what gives us this. So subtract it from 1. You have 0.95. So this is 8.9%, which is, if you divide the 8.9% by 100, let's convert it to decimal, it will be 0.089. Let me confirm. 8.9 divided by 100 is 0.089. I converted the percentage to decimal because this is percent. Equals to, if you subtract this, 0.95 WACC of an ungeared company. So make your WACC of ungeared company the subject of the formula. So you divide both sides by 0.95. So WACC of an ungeared company equal to 0.089 divided by 0.95. Divided by 0.95. That gives us 0.09368 times 100. So we have 9.368. Therefore, WACC of ungeared company is 9.37% to 2 places of decimal. So we have ungeared. Remember, 3 steps were given to you. 1 step is to ungear first. Then after you have ungeared it, the next step is to regear. Now we have ungeared it now. That means the next step is to regear before you can now use your WACC in investment appraisal. So the next step now we want to undertake is to regear this now. Now that you've gotten the WACC of an ungeared company, so the next step is to regear again. So we want to regear. Remember, the WACC of an ungeared company as calculated. WACC of an ungeared company 9.37% or 0.93 0.09368. That is the WACC of an ungeared company. Then after WACC of ungeared company, you need the market value of debt. Now, you want to regear. You want to use the new level of gearing. The level of gearing has changed. So, the market value has changed. So, the market value of debt is 40 million. That of equity is 65 million. So, that is the new market value. So, we have equity, market value of debt 40 million, market value of equity 65 million. Tax rate remain the same. Tax still remain 25%. So now, you want to regear. That is the step now. So our WACC of geared company, WACC of geared equal to WACC of ungeared. The WACC of ungeared is 0.09368 into, or you use 9.37%. Or let me just use 9.37%. We've calculated 9.37% into 1 minus D. Our D is 40 million times tax rate, which is 25%, over E 65 million. Debt 40 million. So we have 9.37% into 1 minus. Let's evaluate this. 40 million times 0.25, that gives us 10. And the numerator is 10. Denominator is 105 divided by 105. That gives us 0.095. No, the sum of this is 105. So if you subtract this from 1, you have 0.90476 times 9.37. So the WACC of a geared company, WACC of a geared company is 8.48 or 8.5%. So that is the solution to the B part of the question. C, you have to calculate cost of equity capital. And the formula for cost of equity, we have KAG, cost of equity. We have KAG equal to Q plus 1 minus tax rate into Q minus KD into D over E. This is the formula for calculating cost of equity based on M&M Proposition 2. So I've given you the procedure is to ungear first. Ungear or degear. The cost of equity, the old cost of equity, to ungear, you use the old data. The old cost of equity is 10%. The cost of equity is 10%. The tax rate remains 25%. Cost of debt is 6%, which is, yes, 6% pre-tax. Then the market value of debt, 20 million, that of equity, 80 million. So we want to use those variables now. So we have KEG, cost of equity of a geared company. That was 10%. Tax rate, 25%. Cost of debt, it was 6% pre-tax. The market value of debt, 20 million. That of equity, that was 80 million. We are using the old data. So KEG, substituting into the formula, we have 10 million being the cost of equity of a jet company equals to, the process now we are undertaking is to ungear. This is 10% equals to Q. We don't know cost of equity of an ungeared company plus 1 minus tax rate. Tax rate is 25%. So Q is unknown minus cost of debt. Cost of debt, that was 6% pre-tax. 6% pre-tax into market value of debt, 20 million. And that of equity, 80 million. So we have 10% equal to Q plus this will be 0.75 if you subtract this into Q minus 6% into 20 divided by 80. That gives us 0.25. So we have 10% equal to Q plus, let me multiply this one and this. This times this. I want to multiply the two. 0.25 times 0.75. That gives me 0.1875 into Q minus 6%. I've multiplied out these two. That's how I got this. Let me open the bracket now. 10% equal to Q plus this times Q, it will be 0.1875 Q minus this multiplied by 6. That gives us 1.125. So this and this are like, this and this are like. So if I add this and this, this is in percent because of the 6% here. If I add this and this, if I add this, the coefficient of this is 1. 1 plus this, it will be 1.1875 Q equals to 10 plus this, it will be 11.125%. So Q, so if you let me divide, I'm supposed to convert this one to decimal. So if I convert this one to decimal, by dividing this by 100, it will be 11.125 divided by 100, it will be 0.11125. I converted the percentage to decimal, divided by 1.1875, divided by 1.1875. So we have 0.0 Q 0.093684 and so on. If you like, you can take it to percentage. So this, if you want to take it to percentage, you multiply by 100. So you have 9.37%. Q equal to 9.37%. That is the cost of equity of an ungeared company. So, but what you have to calculate is cost of equity capital. Remember, the company is geared, so you have to re-gear the cost of equity again. We will always undergo 2 stages. We first of all ungear, then we re-gear. Now we want to re-gear again. Remember the formula for calculating the cost of equity in an ungeared company according to M&M Proposition 2 is Q plus 1 minus tax rate into Q minus KD into market value of debt over market value of equity. Now, we've gotten our Q, that is cost of equity of an ungeared company. Our Q is, we got 9.37%. That is the cost of equity, or you may use 0.09368. Let me use 0.09368. So, if you substitute into the formula, our Q is 0.09368. Tax rate remains 25%. Remember, you want to use the new market value now. Cost of debt is 6%. Remember, we said at all levels of gearing, if you look at M&M Proposition 2, the line representing the cost of debt is horizontal. So, since that line is horizontal, we said at all levels of gearing, the cost of debt remains the same. So, that is why we are still using 6% for cost of debt. So, the old cost of debt will be the same. Cost of debt in an ungeared company will be cost of debt of a geared company. So, at all levels of gearing, the cost of debt remains the same. So, the market value of debt, that is from our solution to A. We got, the debt was 40 million before, another 20 million, 20 million before, another 20 million added. So, it made it 40 million. That is the market value of debt. And when we calculated the value of equity, the value of the firm, we got 105 from A part of the question. So, and the equity and debt were separated, and we got the value of equity to be 65 million. So, that was from the solution to A part of the question. Now, let's substitute into the formula. KEG equals to Q. Our Q is 0.09368 plus 1 minus tax rate. Tax rate is 25%. Q is 0.09368. So I want to extend the solution to this part. That is why I'm rubbing up that part. Q is this, minus cost of debt, 6%, which is 0.066%, into market value of debt, which was 40 million, and that of equity was 65 million from the solution to A part of the question. So we have, now let's evaluate this. 0.09368 plus, if you subtract this, you have 0.75. This is 0.75 multiplied by, if you subtract this again, 0.09368 minus 0.06. Then this one gives us 0.03368. Then if you divide this, 40 divided by 65, we got 0.615385. So if you multiply this out, what is the product of that? This times this times this times 0.03368 times 0.75. So we have, this is 0.09368 plus this one is 0.01554. So if you add it to this, plus 0.09368. So we have 0.1092. Therefore, KEG equals to, if you convert it to percentage, multiply by 100, 10.9%. So that is the cost of equity of a geared company. I will stop this lecture here. In my next video, I will examine M&M propositions with tax, where additional capital is raised. If you find this video useful, please drop the love emoji, like the video, also share it with others. Thanks for watching ZICA.